Let's talk a little bit about investors owning Treasuries right now. They have been pulling in profits for much of the year, but now Treasury yields are near their lows for the year, and the risks are rising. Bloomberg reporting today that the risks of owning Treasuries are now at their highest level in almost 60 years. Joining us now to talk a little bit more about this, Kathleen Gaffney. She's co-manager of the $20.7 billion Loomis Sayles Bond Fund. That fund, by the way, has been avoiding Treasuries for at least 2 years, but that has not hurt performance. The fund ranks in the top 2% of its peers year to date and the top 4% over the past 5 years. So great long-term track record, Kathleen. It's why we like to talk to you. Welcome back to Street Smart.
Thanks, Carol.
So what do you think the outlook is for Treasuries? I mean, a lot of folks are betting against them, and so far it hasn't proven right. But where do you think we go from here?
I think they're right in the long term that there's a lot more downside and a little bit, very little upside here.
I mean, it's at a point where how much more upside can there be, correct, in terms of where we are in terms of levels?
Not much. And who wants to clip a coupon that's below 3%? Not me.
Give me an idea, because we've been looking at the economy. That's certainly on everybody's minds. Coming off of that Friday jobs report, we've got a story on the Bloomberg, out from Bloomberg News, talking about economies kind of starting to rethink some of their rosier outlooks. Where do you think the economy is headed, and what that means for the Treasury market?
It does seem that we're hitting a period of slower growth, and that's been a support for the Treasury market and helped it rally below 3% on the 10-year. I think that is quite possible that we're in this very slow period for several months, and that's just a very short-term period. I still think it makes sense to be positioned for continued recovery in the economy longer term.
Well, okay, so define longer term for me, Kathleen. I mean, 10 years we could be in better shape. I mean, what's long term for you?
Great question. Hopefully we are not Japan, so it's not long-term in that sense. But I do think we're in uncharted territory in terms of it could be, as Bernanke has been saying, an extended period where rates remain low. And that's a prop for the Treasury market. But that doesn't necessarily mean it's a good time to be invested in that area.
I mean, you guys have been avoiding Treasuries for some time. I mean, how long? Remind me how long and why you've been taking this position.
We've been backing away from Treasuries for about 2 years now, and really the reason is because when we look at the long-term risk-reward, there's greater downside, and going back 2 years ago, tremendous upside in particularly the credit markets, but also in getting away from the U.S. dollar. Now, spreads have narrowed considerably. We've seen credit perform very well, and it may be a bit stretched in terms of valuation, but I would much prefer to earn 6 or 7% on a corporate bond than hold a U.S. Treasury long term.
Well, that's interesting. I mean, there are some companies out there who, investing in fixed income is part of their strategy. They like the intermediate part of the curve here. Do you find any interest in that, Kathleen?
I think the intermediate part of the curve can look attractive. I'm not as concerned about the maturity per se as finding the right credits, being a real selective bond picker in this market, because you want that yield advantage, but you really want a company that's going to be able to manage when growth is positive, but much slower than we've ever seen before in a recovery.
Now, Kathleen, we kicked off this segment saying, we talked about a Bloomberg News story that talks about the risks in the Treasury market have risen to levels not seen since the 1950s. Do you agree with that premise?
Yes, I do. I don't think we've seen this type of risk in the market, and I think that's why it's a good time to get away from the Treasury market, get away from duration in the portfolio, and really look at the individual issues that you hold in your fixed income portfolio.
Now, we've got Ben Bernanke coming up tomorrow afternoon, Kathleen, giving a speech. I think it's entitled The U.S. Economic Outlook. Pretty general, pretty vague here. I mean, anything you think we could get from Uncle Ben here that could impact the Treasury trade tomorrow?
I think he's probably going to be very talking to the market about what their current view is, how they're reading the tea leaves in terms of where the economy is, and I would expect to continue to hear that language about an extended period of time, and that should be supportive for risk markets as well as the Treasury market.
So does that mean to you that we could potentially get more quantitative easing from the Federal Reserve?
I think QE3 is out there, but as the central bank has been talking, that they've set a high bar. They don't want to use it unless they have to. I think there is some fundamental support in the economy that should continue, but it may get difficult over the next couple of months because it does look like we're in a bit of a soft patch.
Yeah, it certainly feels that way. Kathleen, got less than a minute left. So you mentioned that you've been shunning treasuries, you guys, for about 2 years here. Where do you like, or what do you like in the fixed income world?
Well, as I mentioned, we do like credit, and particularly higher yielding credit, although I would say valuations are stretched. So we want to focus on particular names. And then when we can't find opportunity there, I think there's good long-term value in the non-dollar markets, particularly the commodity currencies that should benefit from global growth, as well as the currencies in both Latin America and Asia. Those are great inflation hedges, and the challenge for fixed income markets over the next several years to come is one of rising rates. So you want to buy bonds now that are going to help you when rates do actually start to rise.
I think I got a few more seconds here. Dare I ask about Europe and what's your position, just quickly?
I think there are opportunities in Europe. There are challenges from a political perspective, and you have to be very careful about valuations. But I think that through all this chaos and distress, there are some good opportunities to be found there.
Just got to find them, right?
Exactly.
We got to run. Kathleen, good to get some time. Kathleen Gaffney of Loomis Sayles.